Good morning, friends. My name is Rashmikumar Shah. Welcome to our monthly or bi-weekly webinar. Before we start, just a disclaimer that this webinar is for people living in India and Indian residents investing in India. This webinar is not for anyone living in North America, or it's not promoting any investments from citizens of North America. Yeah. Now, thank you very much. With this, let's start. So, we all now know that we are in a bull market, and in a bull market, maximum mistakes are made. So, in bear market, maximum opportunities are lost, but in the bull market, maximum mistakes are made. As I've been in this field for last 40 years, I have seen, even I have made a lot of mistakes in a bull market when markets are doing very well. So, in today's webinar, I'm going to cover what mistakes we should avoid and how you can improve your investment performance during a bull phase. And I'm also going to cover what happened exactly on Friday, why the market corrected so sharply. We saw almost a 4-point correction, almost a 2,000-point fall on BSE Sensex. So with this, let's start, and please feel to ask questions. There is on a text. You can text the questions on the on your YouTube channel, and also would like to subscribe to our YouTube channel. Okay, thank you very much. So let's begin the Sensex journey from 400 to 50,000. Correct. So in January 1986, Sensex was 500. The base year for Sensex was 1980, 100. So from 100 to 500, it went in 6 years, and from 100 to 1,000, it went in 10 years. So what it means is, during the period 1980 to 1990, Sensex doubled every year. I'm saying it doubled every year, correct? But if you see, the last time it doubled from 25,000, it was in till February 21. That was from June 14 to February 21. It has almost taken us 6 years. 6 years, correct? In 1980 to 1990, Sensex was doubling practically every year. So if people are saying the market is too hot, they are mistaken. Sensex took 6 years to double from 2014 to 2021. Now, if you see the period between 2006 and 7, from February to 2006 to December 2007, that's 2 years. It went from 10,000 to 20,000 in a span of 2 years, correct? So, when economy recovers, Sensex moves very fast. The markets move very fast. That's what it's telling you, correct? Now, in last 5-6 years after demonetization, it took. So in May 2014, when Narendra Modi got elected for the first time, BJP, Sensex crossed 25,000 in June. From that 25,000 for 50,000, the journey was pretty long, 6 years. It took 6 years because of demonetization, GST, a lot of structural changes he made, real estate pain, and banking and financial crisis, so many frauds coming up, correct, in the banking system. So it slowed down India's economy, and it took almost 6 years for the Sensex to double. Now we are set. There's a momentum. Now from here, if Sensex has to double, it can, like in 2006 to 2007, it took 2 years. It can, in 2 years, it can double also here this time, correct? So if it doubles, means it can go to 1 lakh. You may think, oh, it's impossible, Sensex to go to 1 lakh. It can go to 75,000, which is also 50% from here in next 12 months to 18 months. It is possible. The probability of that is very high. So I'll give you a different example. Now, imagine all the people who are working with you. the local people in Pune, Bombay, the average driver, average carpenter, average plumber, average factory worker, they are all earning on an average a salary of 15,000, or 15,000 per month. Uh, Now, all India basis, average person is earning a salary of 12,000, including rural India. Those who are between the age of 18 to 60. Uh, Now, if the person is earning the average monthly income of 12,000, ask yourself, can that 12,000 income double from 12 to 24 in next 4 5 years? Yes. So average rickshawala or average driver or average plumber, his income can go work factory worker. His salary can go from 12,000 monthly income to 24,000. Is it possible? Yes, it's possible. It's normal, correct? Even if you take an increase of 12 to 15% a year, it will double in 5 years in normal course. So if his income is going to double, India's GDP is going to double. If India's GDP is going to double, normally when stock GDP doubles, the stock market goes up 4 to 5 times. So if GDP doubles, the index goes up minimum 4 times to 5 times. Now, so what I'm saying is, if GDP in next 2 years, even if it doesn't double, it goes up by 25%, 12% or 10% every year. Index will go to 80 to 90,000, because what happens is the big companies, the corporate private sector captures the higher share of the growth of our economy, and that's what's going to happen. That's what's going to happen. So, market looks very bullish, but maximum mistakes will be made by investors in during this phase because of greed. Of the two factors, managing greed and fear, managing greed is very difficult. So I want you to focus on that. So I'm going to focus on that today. What kind of factors you need to focus, correct? Now, if you look at this, since 1986 to 2021 February, the Sensex has given a rolling 13.6% CAGR. A bank deposit has given bank FD has given 7% return, whereas Sensex has given 13.6. Inflation is, let's say, 6%, 6 to 7%. So bank FD real return is zero or negative if you take after taxation, whereas a Sensex has given you 6 to 7% higher return than the inflation. So investing in the stock market makes sense, correct? But why people lose money? Because they speculate in the stock market. Now I wanted to show you certain phases, correct? Now if somebody invested here and he sold here, correct? So then he's getting a negative return. So these are speculative. So same thing, somebody invested here, then he sold here, he got a negative return. That I'll show you in the next chart, correct? Sorry, let me go back to the previous chart. Yeah, let me go back to the previous chart, correct? Sorry about that. So the rolling, you can get negative returns. And so if you're speculating, but if you're investing, you can get a 13.6% return, yeah, in the stock market. Now, it's very difficult for people to manage their emotions, and that's why they are not able to get 13.6% return or 14% return consistently. They try to time the market, do all kinds of permutation combination to get a higher return, and that's where the fallacy is. So let's look at the Sensex from other perspective, correct? How the Sensex has changed over a period of time, how Indian economy has changed. In 1990, we had you see the stocks, the top 10 stocks in the Sensex, correct? If you see this top 10, there's not a single ID company. The manufacturing companies are there mostly, correct? And FMCG companies are there. So India had a higher share in manufacturing and agriculture, and services sector was just coming up that time. Today, the services sector is 70% of India's economy. So if you see today in 2021, you have Infosys, HDFC Bank, HDFC, this are all services sector, TCS, Axis Bank, and the manufacturing, you hardly see any company here, correct? You don't see companies like Grasim, you don't see L&T. So the manufacturing sector has taken a backseat. That's what has happened. The composition of Sensex has changed. Now, So that's also very important to understand. As the economy changes, your investment style has to change, your investment selections have to change, and this is where fallacies happen. Except for companies like Hindustan Lever, Reliance, which were there for all those 5 years, all the 5 decades. Most of the other companies, the composition has changed. As I said, there were no IT companies in 1990s, and even in 2000, correct? Even in 2000, and they have come up afterwards. Now, MTNL was there, NIT was there in the year 2000, but they have taken a hit, correct? Except for Infosys, which has been there consistently after the year 2000. So you need to understand how the dynamics of the Indian economy is changing, and accordingly your investments have to be done. This is another fallacy where people have made mistakes. They have went in the wrong sectors and in the wrong time, because a short-term memory is very strong than a long-term memory. We focus short-term. So what happened in last 10 years? So in year 1990, what happened in last 10 years? They invested in the year for the next 10 years in those kind of sectors, but the economy changed, so they missed the bus in technology sector. That's what's happening. So we need to focus more on from a long-term perspective, understand what is the long-term changes happening to the economy. So one of the changes, the change in the economy from manufacturing to service sector over the past 3 decades, one of the key features of the bull run from 1990 to today is that the shape of Indian economy has changed. So I give you a classic example. There are different sectors, correct? So ask yourself, which was the sector which had the maximum inflation in last 30 years? People say, oh, food prices have gone up. Really? Not that much. Really not that much. That sector has not had a high inflation. The highest inflation was in the education sector and the healthcare sector. I, as a chartered accountant in 1980s, I passed. I spent only 100 or 200 rupees on my entire education. My school fees was only 1 rupee, whereas you used to get 12 samosas in 1 rupee that time. And my monthly fee was only 12 samosas. Today, can you get school fees in that 12 samosa prices? No. The education has become extremely expensive. The services sector had a highest inflation, which we may not see in the coming 2 decades. The other thing, so that's the pattern of the Indian economy change. Then the rise of private sector post-liberalization. After 1990, up to 1990, PSUs did very well. After 1990, the private sector has done very well. That's what you see in the PSU stocks, correct? The PSU stocks have done horribly wrong in the last 20 years, and the private sector stocks have done very well. Now, after the other thing you have seen, the top two sectors in last 40 years or 30 years is private sector banks and technology. So if you are not heavily overweight in technology and we are not heavily overweight in financial and stocks, then you are underperformed. So that's what other thing has happened. Then what is one more change which you are seeing? The composition of index has changed. So you need to keep changing your investments based on the sectorial trends, and that's where we at Simplicity are specialized in that. We focus on sectors, not on company stocks. We focus on the sectors where we think there is going to be maximum growth. We invest in sectorial funds instead of in buying stocks, because when you start trying to buy stocks and build a portfolio, your allocation to sectors may be wrong and you may miss that overall growth of the economy. So out of the 30 stocks in the Sensex in 1990, only 4 are there since inception, which is Reliance, HUL, ITC and L&T. This has changed. So otherwise everything else, all new companies have come there, correct? And so this is what has happened in the last 30 years in the bull market. Now, as I already mentioned in the past, that CAGR has been 13.6, but people have not got 13.6% return. What is the reason for that? Because they try to time the market. So if you try to time the market, at times you can get minus 50% return, and you can get as high as 264% return. So if somebody invested at the bottom year, he get to. But how many people invest at the bottom year? 1 in 10,000, correct? 1 in 10,000. I mean, most of the people start investing here at the top and then they sell here, correct? So we try to time the market, and that's where people have lost money. The so the markets have India's market cap has gone to almost now 2.7 or $3 trillion. Who has made this money? The people who have stayed invested in the market. Sorry, excuse me. If you see India's investors, there are two categories. One are speculators and short-term traders, and one are pure investors who invest through mutual funds. Did you know that the National Stock Exchange of India, NSE, has the largest number of derivative contracts in the world? So options and futures, it have 3 times more contracts than NSE, Nasdaq, or New York Stock Exchange. I didn't know that. I just came to know last week that the NSE is the number one speculative exchange in the world. So Indian investors are more speculative and less of investors, and that's why the many times stock market gets a bad name, because people lose money. The chances of, if you are a speculator, 98% of speculators lose money, whereas 99% of investors make money. Now, so if you are an investor, you don't have to worry. You have to follow a process, and you will make money. And that's what you have to go. But the markets will give you opportunities when this kind of correction happens, like the correction last Friday, 2,000 points, very good corrections. I'll talk about that later, why that correction happened. But you should use those opportunities and invest. Now, what are the trends in India, upcoming trends? So there are 10 major trends, correct? Which I'm going to talk about, 9 major trends, sorry about that. Information technology sector is going to lead the change. As India is getting digitalized, I'll give you a classic example how digitalization is boosting Indian economy. When I was growing up in 1990s, if you have to make a payment for a vendor from Pune to a vendor in Delhi, I had only 2 options in the bank. Either send the payment to a demand draft, they call DD, or is make a wire transfer. Either way, when I do take out a demand draft, I have to pay the money to the bank in advance, and the bank gives me a guaranteed check, which is called demand draft, and I give it to my vendor. That whole process is to take 3 days. So my money used to get blocked 3 days in the banking system, and bank used to get free cash to use it for 3 days. Today, with RTGS and NFT, the money goes in 2 seconds, correct? The money gets transferred instantly. So what has happened? The technology sector is leading the change. That is because of technology, you can transfer the money in a few seconds. And what happens because of that? The money is rolling faster. When money is rolling faster, the economy grows faster. So technology, still today, only 40% of Indian people are doing banking, correct? 60% are still dealing in cash. As more and more people come to the banking system, you will see the more important the technology sector is going to play a role, like making payments through phones, correct? GPay or Paytm, instant payments, correct? You can buy a vada pav on Paytm, correct? So that kind of technology is leading the change, and that's going to boost India's economy. The other thing, the most important other trend, which I want you all to focus, and this is going to change the India's composition, which have been of the economic growth, is the population growth of senior citizen, people above the age of 50, is going to grow up by 600% in next 10 years. 600%, whereas the population growth of kids between 0 and 10 is going to be stagnant. There is no growth of population. The number of kids or number of babies between 0 and 10 is not going to grow, because now everyone is having 1 or 2 kids. So the population growth is going to stabilize. But as more and more people get old, India's which is going to change the entire composition of Indian economy. What senior citizens do, they have a lot of cash, they spend a lot of money on services, so the service sector is going to boom more in India. So you need to understand that the demand for schools, private schools or education is going to be less, which was very high in last 30 years, because 0 to 20 or 0 to 10, the population growth was 600% in that age group. Now that growth, 600% growth is going to go to the senior citizen. So the entire composition of Indian economy is going to change, which you need to understand. India is going to be a major supply chain. India is going to play. So as you know, there is an intense competition between US and China, and America has been really shattered and really scared of the competition it is facing from China. They have no other country in last 100 years has come so close to America in competition. America was isolated and from the whole world, and it is natural advantage it had, and that advantage it's losing because of China. China is neck and neck, and they are really scared of that now. So they want to, America wants to move the supply chain lead which China has from China to some other country, and India is the natural ally of America. So that is going to benefit. So you will see a lot of investments coming to India. So as you're already hearing, Apple is coming, Tesla is coming, so many semiconductors, chips, manufacturing plants are getting installed in India. Then this is going to be a major trend, and this is going to boost India's economy very well in the next 5 years. Then large companies will increase their market share. So as I said, as the economy grows and technology grows, people go for higher branded goods, and higher branded goods means more corporates, correct? Instead of buying street products, they'll buy products from more branded stores, correct? So that change. So corporates are going to benefit more. Then financial assets allocation in India's wealth is going to increase. So people traditionally, if you see, my grandfather never invested in stocks. He used to invest in LIC. He used to invest in those PPF and bank deposits more. Now I don't invest in LIC. I invest more in, I don't buy money back policies. I invest in financial assets more. Now there was a craze for buying property for last 30 years. That craze with the pain in real estate of last 8-10 years, people who got trapped in real estate, they realized the importance of financial assets. So you will see more and more high allocation coming to financial assets. Gold is going to lose its charm. The reason is what has happened in Western world. People have started, those who used to invest in gold, they have started moving to bitcoins. So the demand for gold for as an investment, as a this to replacement to dollar has moved from gold to bitcoins. So gold is only going to be used now for jewelry, and that was India. But 50% or 60% demand for gold is to come from investors to hedge against the dollar, and that is moving from gold to bitcoins. So financial assets. So in India, all those gold lovers, they are going to feel a pain for next few years, and that again the asset allocation is going to change from gold to finance. So we'll see more and more people coming to stock markets. Then fintech revolution, I said, fintech revolution is going to speed the growth of India's economy as money starts rolling faster and more efficiently, and the cost comes down. Then again, another new things are happening is a lot of startups are coming to India, which is good, like Paytm, so many Make My Trip, so many new startups are coming, and they're getting listed in America or India, and that is going to, and as I said, in next 5 years, the average income of every person in India is going to double because of increase in productivity. So GDP is going to double. And what has technology revolution brought? What did we learn in the year 2020 because of COVID, that you can work from anywhere? So when you can work from anywhere because of 5G and 4G and all this, you don't have to live in Bombay. You can live in Satara, you can live in Vai, and you can work for your company. So the movement of people coming to major cities or metroplexes is going to slow down, and even rural India is going to benefit and is going to see a lot of development there. Because I would prefer to live in Vai or Mahabaleshwar, where the weather is very good, rather than staying in Pune, correct? Last 1 year I've been working for simplicity, sitting in here in US. I don't have to be physically present in Pune. So that is going to change. So these are the major 9 things which you have to keep in focus and behind your mind when you're building a portfolio. The bull. Now, what mistakes we make in a bull market, correct? Bull market, the maximum mistakes, what harm investors happen is not the fear, it's the greed. The greed does maximum. Because of greed, what you do, you don't have any plan. You directly jump into the stock market without thinking. And when you do that, you are bound to fail. Like, if you don't have a plan, like, you see the construction activity in India, there is no major city planning done. So everybody comes, buys a plot and randomly builds a building. So you see how the cities get caught. Whereas you see in the Western world, the city plan is very clear, correct? And everybody builds the home. So there is same way is about your portfolio. When you randomly build your portfolio haphazard way, then you lose the charm. That vision is lost and it becomes a mess. Other thing, what I've observed, this I've observed in India and America, both places, all the new investors, they don't have education, so they directly start by reading in newspapers and media everywhere through speculation. Like in India, there we have called Zerodha. In America, we call it Robinhood. They promote speculation. So 80% new investors start their investments through speculation, and they don't have any education. So what happens when you start your investing life with a speculation, derivatives, and all short-term thinking? Most of the youngsters, they want to buy a stock today and they want to sell. In fact, if I was today 25 years old, I would identify stocks and I won't sell it for next 30 years. I had bought very good stocks in 1980s, and I had almost 20,000 HDFC Bank shares at 25, but I sold when it became 125 or 200. If I had kept it, though from 25 to 125, it gave me 5 times return. But if I hadn't sold it, if I hadn't traded it, today they what? It has given split after split after split. That 25 rupees would have become today 20,000. But I missed that bus. Why? Because of my trading. So these are the mistakes we do. And then emotional investing. How many people invested in March 20, when the markets were low? Very few, correct? 1 in 1,000, because they were scared and emotion. That was the right time to invest. Now, people do a lot of emotional, he made so much return, I'm left behind. They jump. Don't do that. So no, then they're not sticking to a plan. Like, when you go to a railway station or you go to an airport, before that, you're going to Jaipur or you're going to Delhi or you're going to New York. You don't change your plan after going to the airport. Aaj New York nahi jana hai, I will go to Tokyo. You don't do that. But in investments, people do that. They come with that, okay, I'm going to invest in this and this, and then suddenly they change their mind and they change their investment philosophy because of greed. Stick to a process. Stick to discipline is the most important thing. Like in real estate, location. In investments, it's a discipline. If you don't have discipline and if you don't have a plan, forget about making money. You will never make money. So these are some of the mistakes people do. Then poor risk management. The risk management, they always assume when I invest, markets are going to go up. No, it never happens like that. Everything in life has something opposite, correct? So no matter what, there is always a twist everywhere. So always prepare. What happens if I invest and markets go down by 10-20%? What I'm going to do? So before you do the investments, if you don't have that kind of plan and thinking, and you don't have risk management, you're bound to lose money. And that's the problem. So we always assume, at Simplicity we recommend investments to client, we always assume there's only 50% chance that in next 6 months this investment is going to go up. But there's a 100% chance that this investment will go up in next 5 years. But I don't know how that investor is going to behave for next 6 months when markets go down. So we always assume what is the risk mitigation for that process, and we do that. So every investor need to do that. And this is the biggest mistake people make in the bull market, and that's why we get corrections like what we got in Friday. So now, if you see, this is a data we took last week of the top 20 or stocks which are traded highest volume. See, Idea, Punjab National Bank, Central Bank, Syncom Formula. I've never heard of this company. IOB, Yes Bank, Union Bank, Bank of Baroda, Jammu and Kashmir, GTL, I don't know which company is that. Suzlon. Suzlon, I've been there, number one trading stock for last 10 years. I don't know how many people have lost money. See, then take Arcom, bankrupt, correct? This stock was 700, it has come to 1 rupee 72 paisa. People are trading in this kind of stock, 78 paisa. You can never create wealth by investing in this kind of companies. Yeah. Now, some of them are, okay, State Bank is good, IDFC Bank is good, Idea is good, though Idea is correct, but this is a good management company, they will do well. But others are PSUs. See what has happened here, except for Bail. Bail is okay. But you see what has happened, correct? You can't create a fortune. You can't build a Taj Mahal with this kind of investments. What you need, you can't ride a bull market. Oh, sasta hai to acha hai. People like to go for cheap stock. Why these are popular? Because these are cheap stocks. Now you need to invest in good quality stocks, correct? So see this quality of this stocks, correct? Quality. MRF, Honeywell, Shree Cements, Page Industries, 3M. Why I have selected this? These are high value stocks. These are expensive stocks. How expensive they are? 90,000 rupees. Like Arcom was 1 rupee share, and MRF is 90,000. I think it's now 100,000, correct? Honeywell 43,000. Shree Cement. How many investors have guts? You need to invest in this kind of companies. They grow. 3M, Bosch, Dixon Technologies, Nestle, Abbott, Procter & Gamble, Bajaj Finserv, Tasty Bites. How many of you know Tasty Bites? This is the number one packaged food company which exports 100% exports, and I buy their food products in US. Very good company. It was 5,000 last year. Maruti Suzuki, India Mart, Sunfoy. And these are the kind of companies where you should be investing, but people don't invest in this. They invest in cheap stocks, and that's the other fallacy. Your portfolio need to have this kind of, so even your mutual funds and this, they need to have this kind of stocks, correct? They need to have this kind of companies in your long term. Taj Mahal is not cheap, it was expensive. Look at this way, then what are the brands you are using in day-to-day life? You are using Disney, you are watching what is that, Disney channels, correct? Hotstar. Then Airtel you are using, Google, everyone uses Google, correct? Banking with ICICI or HDFC, Samsung TV or Samsung phone, Westside, you shop, correct? Star Bazaar, Apple, Microsoft, Toyota. These are the brands. We buy groceries from D-Mart, Nestle, Honda, Hindustan Lever. Now these are the companies which we are using in a real day life. How many of us invest in this kind of stocks or this kind of businesses? Your portfolio should have exposure to this. So which a normal investor doesn't do. He goes for speculation. He looks at technical charts. TV पे tips क्या मिलता है? If you can never build your life or based on tips or insider information. God doesn't give you tip. Nobody gives you tip. All that is all fooling business, and you are going to lose money. And that's the trend, correct, of a novice investor. A mature investor never does that. I have never invested based in my life anywhere in tips. I've invested on trends. You need to focus on that. Clients, now what I'm going to do, I'm going to share here what I've experienced. I've been in this business for the last 40 years. Right from the age of 20 to I'm now 60, I've been managing clients. And I don't know how many thousands of clients I've managed over a period of 40 years in India and America. I have seen a pattern of behavior, what mistakes, and even I have done mistakes. So even I have changed over a period of time. So I'm so the behavior. So in the stock market, when you invest, there are two things, correct? One is your so as an advisor, when I'm as a person who I'm helping people invest in the market, I have two challenges. One is the market, which is unpredictable, and one is the client. Now, I want the client to be predictable. Now, if client is also unpredictable and market is also unpredictable, my job becomes very difficult because I'm managing two unpredictabilities. But if I have a client has a predictable behavior and he follows the process, I don't have to worry about him. I have to worry about the market, which is my job. So I can manage the risk in the market very well. Now, but if I have two unpredictabilities, it becomes very difficult for me to help the client create wealth, correct? So what we did, let's say on 0 to 10 basis, the behavior matters, correct? A very good behavior is 10 and a very bad behavior is minus 10. So we rate. Now, I never tell the clients what rating he gets because unless he's getting a perfect 10 rating, then only I tell the client that you are very good. But I try to work with the client to take him to perfect 10, his behavior over a period of time, correct? Minus 10 is the worst kind of behavior, very emotional investor, and the plus 10 is a client who follows everything by the book. He never gets greedy. He never deviates from the process. He follows the process by the book. Like you go walking every day at morning 6 o'clock, 1 hour, no matter what happens. An emotional investor, what he does, he goes for a walk after he gets a heart attack. That walk doesn't make any sense, correct? You need to go to walk right from do exercise right from the young age and maintain a discipline. Your health will be very good. So on a rating of scale of to 10, correct? So let's see how that impacts the returns. So I'm giving you a real life examples. So let's start a client. Why when we are giving the same advice to every client, I am giving the same portfolio to every client, but every client is making different kind of money. So like it's a doctor prescribing the same medicine to all the patients, but some patients recover very fast and some patients never recover or it takes time. Why? Because based on their body structure. Same way, same investments I'm giving to every client, but it takes only few investors make money. So a few years back, one of the fund houses came with a study. The fund has given for last 25 years 25% return CAGR, but only 8% of those investors made money. 92% people invested in that fund never made money because they try to time the market. Now I'll give you an example. I'll finish in 10 minutes so you can start posting your questions. Now here I'm giving a client who gets a perfect score of 10, correct? Now let's take last 5 years. In last 5 years, we went through the entire economic cycle of depression, recovery, consolidation, uptrend, and a boom. So if you take 2016 was a consolidation year, 2017 was a uptrend. 2018 market went into depression because of the GST and real estate. 2019 was a recovery, correct? 2020 was a boom. So in this year, 2020 market went up by 50% from the bottom, correct? Uptrend year it went 15%, year it's 0. And this is the way the market behaved. Now, if the client is investing following the process perfectly. So what I've done, he's getting a minus 13% return here, minus 20 plus 7, 13, minus 5 plus 7, 2% return. So if a client invested, he maintained his SIPs and he kept on investing. He kept on investing following the process. He is getting a CAGR of 15% right from 2016 till 2020 because if he kept on investing and when the markets were low, he got more units of a mutual fund or he got more shares of the same company. The client who enters here, he gets a low return, correct? So he gets a 15% CAGR. So we have clients who have been investing in 3 lakhs or 5 lakhs per month since 2014. And they have built a portfolio of 10 crores, 12 crores, 15 crores with us. And they have got 15 to 18% CAGR right from day one. Right from day one, they have got that. But because they were following the process. They never did any emotional. Now only 10% of our clients are like that, and it takes a lot of maturity to go there. And so we work with every client to go there, correct? Now there are clients who generally follow the process, but in between get affected what friends tell them. They go to Rupali Vaishali every day, or they play golf, and or they go in a social gathering and where everyone talks about investment. They get influenced by that. They watch TV, then they start sending messages on WhatsApp, and they get influenced by that. They break the process in between. So I'm giving them a score of 5, correct? On a scale of 0 to 10, they have 5 maturity level. This score, the maturity level is 10, and so here if I'm giving a 5 maturity level score, their return comes down to 13% CAGR. So instead of getting 15 or 18, they are getting 13, correct? So it makes a big difference in your wealth building. It makes a big difference. But this clients, we work with this group of clients. Now, these are 50% of our clients here. We work with them, try to go there, and we help them, we work them, educate them, correct? But a lot of time goes there. Here, we don't have a client with a 10 rating. It's a very enjoyable experience for us to work with them. They trust us, we trust them. There has to be an element of trust between both the sides. Here, we have to convince them every time. We have to educate them in this case. Now, this is a third category of clients, correct? This is the mistakes which people make in bull run. Clients take too much time to take a decision. So stock markets react very fast. The opportunities come very fast. We tell them, this is the right time to invest. Oh, let me think about it. They take weeks and weeks and they sit on it, correct? And they try to have an opinion on the market. Ours is a full-time job in the market. There is a part-time, and when you do a part-time job, you are going to mess it up, correct? So clients take too much time in decisions and sometimes overanalyze. Media sensationalize this news, WhatsApp, and they get affected by that. So I give them a rating of 2, correct? So they make only 10% return. They get a 10% return. Same investments we are giving. Now, there's another category of client who tries to time the market. They say, I want the bottom. They want a deal. They have a habit of, when you go for shopping, haggling every time. ये कितने का है? 10 रुपए का. नहीं, वो मेरे को 7 में चाहिए. So same thing they do in the stock market. नहीं, market 40 है ना, तो मेरे को 36,000 पे invest करना है. Market doesn't listen to them. Market has its own life, own way of doing it. So they always miss the bus. We have to spend a lot of time here on these clients. And it takes years and years for them to change. And they change by experience to maturity level. And the last category of clients who are extremely emotional and they want to make quick money. So they have a problem in the business, they have a problem in the profession, they have a problem at home. They try to solve that problem by coming to stock market. Oh, नहीं मेरा इतना खर्चा है तो मुझे यहाँ stock market से निकलना है. Stock market is not for solving your life problem. Stock market is investing and riding this thing. If the more you try to solve your life problems to stock market, the more you're going to lose. These are extremely risky clients. They want to do options and futures and day trade. We avoid them. We generally avoid this kind of clients. But sometimes we have to help them maturity. That this is not the way to do it. And so this is the last. So these clients get only 1% in spite of having a boom market. So you see 1, 6%, 10%. So we don't tell the client which category they fit in. We educate them because nobody likes criticism, correct? So we don't do that. But you ask yourself which kind of client you are, what kind of a client you are, how mature you are, how much process you follow. Now, how do you know that, what kind of client? If you are checking your investment statement every day, you are an emotional client. I have clients, the 10 category clients, they check the investment statements once in a month or once in 3 years, 3 months or once in a quarter. Their maturity level is so high, so high. So if you're going to check your investments values every minute, highly emotional, you're bound to make mistakes, If you overanalyze, don't overanalyze your invest. So what are the other, this is my last slide. And then I take questions. Behavioral analysis, you need to avoid, and why that emotional mistakes you make in the bull market, you become overconfident. You bought one stock, suddenly it went up 20% in 1 week. You get addicted to that, correct? And then that short-term trading and greed will make you overconfident. So those who invested with us in March, April, May, June, they got 70-80% return. So they're getting overconfident, and oh, don't be overconfident. Markets can go down. So we have to have a plan. We have to have a strategy. Follow that. Avoid herd mentality. When a train comes on the station and everyone tries to get in, what happens? Herd mentality, correct? Same thing in stock market happens. When sometimes people think market is going to go up, everyone tries to get in and they try to, oh, don't do that. Invest when nobody's investing, correct? Invest in stocks where nobody's talking about. Invest in sectors which nobody's talking about. See, information technology fund, I'm just giving you an example. India changed in last 20 years through IT. What is the corpus of all IT funds in India? Not more than 600-700 crores. In a $2.5 trillion stock market of India, IT funds have only how much? 600-700 crores. We have 20% of that 700 crores. We have invested 30-40 crores in IT funds, and those funds have been there. People are not investing. They go to sector. They go to all other category, correct? So avoid herd mentality. Don't look at fundamentals while investing. Don't chase momentum. Like if you are noticing in US, also there is a lot of speculation. Robinhood, correct? You must have GameStop stock. From $4 it went to 400. In America, there are no circuit filters. Like in India, there are circuit filters. Here, a stock can go from $4 to 400 in a day. That can happen here. So many people chase those kind of momentum. Don't invest in those kind of stocks. Anchoring, correct? My friend made so much, I need to. Oh, my friend is doing this way, he made 100% return, so I'll follow him. Don't do that. Don't do that. Or you have a fixed notion, I want 40% return, 50%. Market doesn't care what returns you want. Market will give the returns what it deserves, correct? So don't make those kind of mistakes. Then other mistake is, don't try to get the highest return. Be happy that if inflation is 7%, if I get 14, I'm happy. Why people, all these PMS schemes, lock-in products, why people invest in them? Because they promote them that you'll get the highest return. I will never invest in any PMS schemes. I'll never invest in any lock-in product. After my tax-paid money, why should I put my money in a lock-in product? It's like a child marriage, correct? At the age of 8, my marriage is fixed and I got locked in, correct? And then I get to know who my spouse is at the age of 19 or 20. No, why would I do that, correct? Why I want to get tied up at the age of 7? So same way, don't invest in products where you say you cannot get out of this investment for next 5 years. No, so avoid those kind of mistakes, correct? Avoid, and those kind of products are sold by companies that you'll get very high returns now. And mostly super HNIs do this kind of investments, and they call alternative investments, where maximum money is made by the advisor. Deal mentality. Also, never try to time the market. Market is 50,000, I'll wait for 45. Market is 40,000, I'll wait for 36, I'll wait for 10% correction. No, market doesn't wait for anyone. Market is your own life. Follow a process and invest and build your portfolio. If market comes down, invest more, fine. But don't try to make a deal out of it. You will always lose. I guarantee you, you'll always lose. I've always seen that. So investing is a very long term. It's a lifetime journey, correct? And focus. So if you are between the age group of 16 and 30 or 40, wealth creation and accumulation phase is the core strategy here. And if you are above 45 to 70, legacy planning, quality investments, and global diversification is the key. So maturity level differs from people to people. When you are 25 and 30, I'm going to invest in stocks for 30 years. That kind of stocks I'll select. That kind of portfolios I'll select. I won't try to do profit booking. Uh, Profit booking is for those who are above 50 because they need money, they need regular income. It's for them. You keep on building. Imagine there was a fund in year 2000, Reliance Growth Fund. I had invested a lot of my clients' money at NAV was 22. Today the NAV of that fund is 1600. Imagine 90% of investors, when that 22 NAV went to 200 or it went to 150, they withdrew the money. And we had invested 60 crores that time. Very small group of investors are still invested. Imagine what a 1 crore at 22 rupees NAV and today 1600. How many times it has gone up? Imagine. You stay invested and build your portfolio. This is the way to do that. And with this, I end my today's presentation and webinar. I would like to take questions now. And I would like all of you to subscribe to our channel. And thank you for tuning in. Now, I'm sure the first question is, what happened on Friday? Why the market corrected? And is it the reversal of the boom? No, the market corrected because there was too much speculation, as I said, everywhere in the world. And, the interest rates, which were practically at less than 0.5% in US for 10-year bond, went to 1.5%. Because of that, when interest rates went up, so when interest rates go up, the growth stocks come down and value stocks do well. When interest rates go down, the value stocks underperform, growth stocks do very well. So last 10 years, the interest rates have been going down, so growth stocks did very well. And everyone, as we have a short-term memory, people have invested heavily in the growth stocks. Because one generation has never seen what value is, correct? And they have all invested in very high expensive growth stocks, and suddenly interest rates started going up, so value stocks started doing well, like oil stocks, old economy stocks started doing well, and so they got trapped, and that's where the correction happens, rebalancing happens. Now in your portfolio you need to have both kind of stocks. You need to have some manufacturing and banking stocks, which are value stocks, and you have to have information technology, they are growth stocks. You need to have both kind of stocks. You need to have Microsoft, Google, which are growth stocks, and you also need to have Honeywell, you also need to have Boeing, which are value stocks. So this is how you build the portfolio. And what happened is, when the interest rates started going up, all the speculative positions had to get unwind, and that reshuffling is happening in the stock market, and that's why that correction happened. And again, the markets are going to go up from here onwards in India, in US, at both the places. This year they expect the US GDP to grow by 7% plus. The early estimate was 5%. Now they have revised it up to 7%, because the kind of stimulus they are going to release $2 trillion in next 2 months. Imagine $2 trillion is equal to India, 80% of India's GDP. That much cash they are going to pump into the economy. What is going to happen? So what has happened is, America, as I said, has been shaken up by China. So when American politicians or American corporates go to China, they see their airports far better than America's airports. They get really rattled. So US is going to rebuild its entire infrastructure, right from airports to roads and everything. So massive investments are going to go there. They are also rebuilding their factories. They want key technologies to be manufactured in America, not in China. Especially semiconductors, the computer chips. Because they think that computer chips coming from China, they can spy on us. So they don't want that, and that kind of scares is there. So the economies everywhere are going to do very well. So this correction is a good opportunity. Friday was a very good day to invest. We called all our clients, most of our clients, and asked them to add on to their portfolios. Even if Monday market is soft, it's a good time to invest. Let me see what are the questions we have now. Yeah, and we'll finish in next 5-10 minutes. Yeah, give me a second. Let me see. The first question is, what do you think of social media and the role social media plays in general in financial markets. Social media plays a positive and negative role. The positive thing is it creates awareness and importance of investing in financial markets, which is good thing, and it spent a lot of education also. But at the same time, sensational social media news. Oh, this guy made 100% return. Tesla is the richest guy in the world, and the stock has gone 7,000% up. That kind of thing also impacts people. Or stock market lost 1.2 trillion dollars on Friday's fall worldwide. People, and they show all those people sad faces. So it's sensationalized. So that's the negative side of it. Then also news and stories get planted by vested interests to manipulate the market. You should so anything on social media, you need to think before you act on it. Correct. I generally avoid social media. I generally avoid news. I do my own analysis and trend analysis, which is very important. The next question is, how are investors of different age group reacting and investing in financial markets now as compared to the previous generation? Very good question. This young generation is very different from my generation or my grandfather's generation, which is good. This young generation does not believe in LIC, does not believe in um, money back policies and real estate. This young generation believes in financial assets more than the previous generation, which is very good. And that thinking is also very open minded. And so we are going to see a lot of investors coming to the stock market. Currently, only 8% of India's population is investing in financial markets in India, in stock markets. We see that happening, that population in America, 60% of population invests in stock market. We won't get 60%, but we'll get at least 25-30% participation in India, which is very good. So that change we'll see. Another question I have, what are your views on hedging portfolio by selling options? No, I would never do that. This is again speculation and trying to trade, correct? Why you want to speculate in the market? If I'm 30 years or 40 years old, I would like to invest and build my capital. When you do selling options and trying to hedging, it looks very fancy word. It's very fancy. It's like, after I got married, what happens if my marriage doesn't work? Should I have options? Can I hedge my marriage? No. If I try to hedge my marriage, it definitely will break. Same thing about investments. Do a proper analysis and invest. Those hedging thing, this thing is only good for, even, we're managing almost about 400 crores of investments. We are not hedging. We are going with the market and we are building, and we know markets are volatile, but we manage the risk, correct? Manage the risk by keeping 20% cash in every client's account and investing through STPs or SIPs. That is the way we would like to do that. But I won't sell by going for options and futures market. I'm taking more risk. Views on recent market correction. What do you expect now? As I said, we expect an uptrend. This kind of corrections are very healthy because markets can't go up every day. And when you try to markets go up every day, it's scary. Then nobody will work, correct? And everybody try to make their livelihood in stock market. That's not a good thing. We need to. So this kind of correction, stock in bull market, you get more sharp corrections than a bear market. A 10% correction in a bull market 2-3 times is normal. So this Friday's correction was only 4%. So a 4 to 10% correction is a healthy thing. And when this kind of correction happens, we should invest. So next question is, since US is pumping the fund in the market, will it impact inflation? Very good question. Very, very good question. So inflation, they are saying, yes, there is going to be inflation in commodities. There is going to be inflation in food prices. But if you see India's economy or you see America's economy, uh, the total GDP, agriculture in India is 10% of India's economy. Manufacturing sector is 20%. So that is 30% of India's economy. Service sector is 70%. Correct? There is no inflation going to be in the service sector. Service sector means I'm talking about education, medical bills. Inflation is not going to be there because they are already. You see how much expensive education has become, and because of the technology, education sector and services sector. See, like I said before, 10 years before, if I want to transfer money from my supplier from India to from Pune to Delhi, I had to pay bank charges, demand draft, and bank money used to get blocked for 3 days. Now RTGS is so cheap and instant. So everywhere technology is reducing the service cost. So there is going to be deflation in services cost, and that deflation is going to get offset with inflation in food and manufacturing. So which is good thing. Overall inflation is not going to go up. So overall interest rates may not go up. Whatever has happened in last week is a short-term phenomenon. Again, interest rates will start going down. It will remain at this level for next 2 3 years. I don't see inflation coming back. In US, inflation is not going to be there because 40% of US economy is healthcare and education. Education is the biggest employer in America. And it has become, my daughter, I my undergraduate for my 4 year college degree, I spent only 500 rupees, I think so, hardly, because I didn't spend anything, correct? But my daughter, I had to spend almost 1.5 crore. Ridiculous, correct? Ridiculous. That kind of US is going after all these universities. Education cost is going to come down. Education cost is going to come down because of this technology revolution also. So the inflation is not going to be there. Yes, but certain commodities are going to be expensive. Food is going to be expensive. But overall inflation is going to be less. And interest rates are not going to go up. Do you think gold bond good to park 5% of the amount? As I said, the government of India is very smart. They know the gold prices. Gold is not going to rally for next few years, and so they are selling gold and getting free money. But I'm okay if you want to park, if it 5% in gold bond and get a good night's sleep. It's fine. Some of my clients have done that. It's okay. It's okay depending on your portfolio, correct? Now, if your financial portfolio is only 20 lakhs, I wouldn't like to invest in gold. I want to build your portfolio. But yeah, if your portfolio is 20 crores and you want to invest 5% in gold, yeah, it's a good strategy, because if you have a financial assets of 20 crores, I wouldn't mind putting 1 crore in gold bonds. But if I am 30 years or 40 years old and I'm building my family and I'm building my portfolio and I have only 30 40 lakhs, I wouldn't invest in gold. I would invest in financial assets. So it depends on case to case basis. Yeah. And also the family background, correct? Yeah. Indians love gold. Now, yeah, I don't see any more questions. With this, I end my today's webinar. Thank you. I would request everyone to subscribe to our channel, so next you'll get updates, keep getting updates on what's happening, and we'll at least try to make one webinar once a month. And thank you very much. Thank you for your time. And many of you who are going to watch this webinar later, do write to us if you have any questions, or do contact us. Thank you. Thank you very much.